Welcome. My name is Kathleen Hanley, and I am the director for the Center for Financial Services here at Lehigh University. This panel is being brought to you by the Center for Financial Services and the Goodman Center for Real Estate here. And on behalf of McKay Price, who is the director of the Goodman Center, I want to thank you for joining us this evening. We're very excited about tonight's program. The topic of the IPO market and the role of SPACs has, if you've been reading the newspaper, received extensive media attention. Only yesterday it was announced that Grab, a company that has a number of different activities such as food delivery, ride hailing, and digital wallets throughout Southeast Asia, is going to do a very large SPAC on the NASDAQ. So our panel today will take a deeper look at the current IPO market and specifically the role of SPACs with an emphasis on the real estate market. I'm sure we will have a very spirited discussion. We are very delighted to have you with us and to have such a distinguished panel of experts who can share their knowledge about many aspects of these markets. We're going to begin by allowing the panelists to briefly introduce themselves, and then Professor Ritter will kick us off with some data on the market today. So, Matt?
Sure. Matt Wolpert. I'm a managing director at Neuberger Berman. I'm portfolio manager of the public securities funds within Almanac Realty Investors. We are a $5 billion real estate investment manager. We invest in real estate companies in both public and private markets. We've done so over the last 25 years. In my role, I manage multiple funds that invest in public securities, have been active in both public and private real estate markets, and we've been active in the SPAC market, both in the sponsor capital position as well as in public markets. In open market purchases. So excited to be here, and thanks for having me.
We should have started with David, but so I'm sorry. I told David he'd go first. I'm sure he was waiting patiently, so I apologize for that. So no, David?
Thanks a lot, Kathleen, and welcome everyone. My name is David Pensen, and I am managing partner of Navigation Capital Partners. We're a private equity firm based in Atlanta, Georgia. And we're focused historically on the lower middle market, although we took a decision a few years ago to focus exclusively on SPACs. So we're actually currently in the process of raising $1 billion fund focused and investing out of that fund, investing exclusively in SPACs. So we sponsor SPACs, we invest in the IPO of SPACs, and we also invest in, on the back end of SPACs, a transaction known as a PIPE, or a private investment in a public entity. So we invest in PIPE transactions as well. I should point out that I am also pretty active in the academic space. I'm an adjunct professor at Emory University in Atlanta, in the Guazetta Business School, where I've taught a course for the past 10 years. So I've taught about SPACs for 10 years, but I've only been investing in them for the past 3 years, which in SPAC land is actually a pretty long time. And in terms of the real estate side, I am on the board of several SPACs, which are in the market, one of which is a company called Shelter Corporation Acquisition Corp, which was started by the former head of global real estate for BlackRock, which is the largest investor in the world, Jack Chandler. He's the chairman, and Chris Weber, who worked also in real estate at Credit Suisse and at Starwood and at several other firms like Hines. On that board, and they're focused on the prop tech space, property technology, which is disrupting real estate. So glad to be here, and glad to chat about any of the issues in and around SPACs.
Wonderful, thank you. Gil?
Absolutely. Thank you for having us tonight. Thank you for inviting us to the panel. People at Lehigh, very much appreciated. Gil Ottensasser. I run SPAC banking and SPAC capital markets at BTIG. BTIG is a 650-person firm, 18 offices globally, a perfect place to compete in the SPAC universe, given their emphasis on sales trading, banking, research, etc. I've actually been around the SPAC space since day one. Believe it or not, SPAC actually, as an asset class, was created back in 2002, 2003. At that time, I owned a small broker-dealer and participated in the very first underwriting as an underwriter, at the very first sale as an underwriter. I've been an active participant in the space since then. So a lot to cover tonight, for sure. But again, thank you for having me.
Wonderful. Paul?
Thank you very much. Paul Galliano from Tishman Speyer. I'm a senior managing director at Tishman Speyer. I've been here for over 27 years now. I currently co-head our U.S. acquisitions business, as well as our global capital markets. Tishman Speyer is a global real estate investment company, as well as an operator. We currently have over 57 billion of AUM globally and 85 million square feet of commercial office, residential, mixed use, and life sciences assets around the world. And, we recently started, getting involved in the SPAC market, and really how we got involved into the SPAC, market as a sponsor was really an evolution of our business. We've always been, as a vertically integrated owner and operator of real estate globally, very focused on embracing technology in our business, and clearly having a large portfolio of over 85 million square feet. We're constantly working with and meeting all these startup companies in the real estate prop tech space as they come to us to bring their businesses and have us use them in our portfolio. So we initially started off with a lot of companies in the real estate prop.
Wait a minute, something just happened.
You just got muted.
Accidentally, yeah.
Paul,
Paul?
yeah.
You're muted.
Yeah, it said I was muted by the host.
Yeah, that was an
So
accident.
Maybe I was talking too long, but I was going to say just quickly, we as an institution have always embraced technology, and initially, in our portfolio as a customer. And then in 2017, after we realized that after becoming a customer of a lot of these companies and helping them grow their businesses and scale their businesses with the strength of our portfolio and our brand, we started investing in, Series A and Series B, startup companies. And then ultimately, as these companies have matured, we made a decision last year to actually enter the SPAC market and become a SPAC sponsor, because it was really just an evolution of the business as an early stage investor. Now, as these companies grow and become public market ready, and looking at SPACs as an alternative to an IPO, we thought it was a great opportunity for us to get in that space. So we actually launched our first SPAC in November of 2020. And we actually announced a merger with a company called Latch in January of 2021, and then launched our second SPAC, in February, of 2021. And we're out in the market now looking for potential target for a second SPAC, and really look forward to spending the next 90 minutes together with this group and really talking about everything about the SPAC market.
Terrific. Before we go to Professor Ritter, I wanted to just mention that you may put questions you may have with the panel in the Q&A or in the chat function. Let's do the chat function. Hopefully that's enabled. And I will look at them throughout the discussion. And if we don't have time in the discussion to get to it, I'll try to get to some of them during the Q&A period. All right, Jay?
I'm Jay Ritter. I am a finance professor at the University of Florida's Warrington School of Business. And most importantly, 33 years ago, I met Kathleen when she was coming out of graduate school and starting an illustrious academic career that has landed her at Lehigh.
Yeah, well, you need to date me, though. Did you have to say how many years it was?
So, Kathleen and I are among the leading academic experts on IPOs, and as many of you know, she was a top official at the Securities and Exchange Commission. For SPACs, I'd like to share the screen and Are you seeing the illustrative SPAC public unit structure?
Yes.
Yeah. Okay. When a SPAC goes public, it's the same as any other IPO. They're selling shares to investors. With SPACs, they're almost always priced at $10 per unit. And a unit is composed of a share and typically a warrant to buy a fraction of a share. The SPAC typically then has 2 years in which to find a merger partner. And with the money that's raised in the IPO, it is put into an escrow account. And in that regard, the IPO investors have no downside risk. They're putting $10 in, the $10 gets invested, put in an escrow account where it earns interest. And if the SPAC doesn't come up with a merger partner that the shareholders approve, investors can ask for their money back. And if the merger hasn't occurred within 2 years, they get their money back. The SPAC sponsor has no choice in the matter. During that 2-year period, the sponsor has an incentive to find an operating company to merge with. It could be a division of an existing company, or more typically a private company. And this is a way for that private company to go public. With the SPAC, there's a dual class share structure. That the sponsor who created the SPAC has typically Class B shares, and unusually these Class B shares have inferior voting rights to the public shareholders. Only the public shareholders can vote on approving a merger. And the public shareholders also have the right to ask for their money back once a merger has been announced. So during this period after the IPO, the sponsor searches for a merger partner, negotiates a deal, and then typically also brings in a pipe investor. Partly that pipe investor is doing due diligence and investing their own money. And giving confidence to public market investors that this indeed is a good company to merge with and the deal terms are attractive. The shareholders then have the right to approve that merger, and most of the time they do approve it, and the deal goes ahead. For instance, as was mentioned yesterday, Altimeter Growth Capital announced a merger with Singapore's Grab that's giving a valuation on Grab of about $40 billion. The SPAC has $500 million in cash, and they also got pipe investors to put in another $4 billion. This is the biggest SPAC deal ever. So assuming the merger gets approved by shareholders, Grab will then receive $4.5 billion in cash, and they're going to retain about 87% of the shares. The public market investors, sponsor, and pipe investors will receive about 13%. So this is equivalent to if Grab had gone public in a traditional IPO, sold 13% of the shares, and raised $4.5 billion in the process. After the merger occurs, the SPAC shares typically change their name into the operating company, and it trades as any normal company would. Sometimes the company does well, the stock price goes down. Sometimes the stock price, the company does poorly, and it's a disappointment. But with the SPAC IPO investors, not only are they getting the shares with this money back guarantee, which is kind of equivalent to a default-free convertible bond, but they're getting a warrant for free. So these SPAC IPOs have been great investments for investors. You put in $10, you've got a money back guarantee, and you've got upside potential. So it's not surprising that in the last year or so, hundreds of SPACs have gone public. Indeed, the big mystery is, why did it take so long? Well, within the last year, there have been actually can't find the other screen share at the moment, but there was a big boom in SPAC IPOs, and at the end of February, market prices kind of peaked. There's been a decline since then, and just in the last few weeks, there's been a decline in the number of new SPAC IPOs. But there are over 400 SPACs out there now searching for a merger partner. There have been over 100 that have gone public and announced a merger where they're in the process of waiting for shareholder approval. So there's been a huge amount of activity there, in addition to a lot of traditional IPOs and an occasional direct listing like today's Coinbase Global. So I will stop there and turn it over to the panel.
So why don't we take up this question about, given the fact that SPACs look like they're very attractive to investors, why do you think it took so long for SPACs to get the uptake that they had? And what are some other advantages that investors might receive other than the ones that Jay discussed? Gil, you want to start us off there?
I will, and that was a great introduction, Jay. It's a pleasure to hear someone talk about it, with a better understanding of what's happening with such euphoric terms. No downside risk, is an accurate comment. I think when I represent what's happening here, I talk about de minimis downside risk in the form of fraud. Potentially, someone can steal from an escrow account, or negligence in the fact that you don't vote your shares properly. But you are correct, Jay. SPAC investors have optionality that they're really only paying, opportunity cost for, like a synthetic zero coupon bond. You're backstopped by a bucket of treasuries. And that's, in 19 years, it has never failed where someone has hit the give me my money back button and not gotten every penny of cash plus the risk-free rate. Your question, why did it take so long? And I think I have the battle scars of 18 years, trying to tell this story. I think a lot of it is just a misunderstanding of what it is. The magic of a SPAC is that, we're taking companies public. We're taking what's called a 419 company public, which is a shell company, which is what's considered a blank check company. And literally since day one, the media has covered this, as a blank check, as a sponsor makes an announcement, enters into a definitive merger agreement with a company, and suddenly you own a company that you didn't sign up for at a valuation that, you do not necessarily agree with. The sponsor, has egregious economics that he's taken advantage of, misalignment of interests, etc., and abuse found in the typical blank check structure. But that's not the case with SPACs, as you so clearly articulated. Every investor will have the ability at the time of the business combination to administer 2 votes. One vote is yes, no to the transaction, and the second vote is give me my money back. And the votes are actually mutually exclusive, which means 100% of the investors can vote yes, which they probably will, because they have no financial incentive not to. And the second vote, they can simultaneously take their money back. And the comment here is just, I think that's been a misunderstanding. I don't think the market has appreciated that, and suddenly they do. I'll stop, I'll pause there. I did want to just sort of give a little bit of clarity, Jay, to your numbers. There literally are 557 SPACs right now that publicly trade. The number is there was 248 SPACs that went public in 2020. At the end of the year, we were all polled and asked as bankers, do we think it'll be a better year or worse year for SPACs? And if you took the over, you were the winner, because in the first quarter of this year, 306 SPACs priced, representing $98 billion. Let me just repeat that for 1 second. 306 SPACs priced, representing $98 billion. So you currently do have, the number is 557 SPACs, 123 of them, including the Latch transaction, are moving aggressively towards a shareholder vote. 434 are currently searching, and the pipeline is 244 SPACs in registration and publicly filed. And if we begin to speculate on what the confidentially filed SPAC pipeline must look like, take the over under on, let's say, 2,000. I think that's what the number is. So I'll pause there, turn it over.
Let me just say one quick thing on that, and it's 261 in the pipeline, so it's pretty big of public filings. But here is one thing that I having taught SPACs for 10 years and asked this question almost every year, why aren't there more SPACs? There is actually a very logical reason, which is that SPACs today aren't always what SPACs were in the past. So SPACs have evolved as a product, as Gil well knows, over the period. What has happened is SPACs used to be much smaller. SPACs used to be much more generalist. There have been a series of structural changes to SPACs. It wasn't always a $10 price. The price used to be variable, which meant many of the SPACs became penny stocks, which was created a different type of issue. The SPAC compensation has changed. It used to be that you could get most or all of the investment banker compensation up front, and that changed to market terms effectively of 2% upfront and 3.5% on the back end. So that incentivized banks to be more involved in that de-SPACing transaction. The pipe market has grown and become more sophisticated. The players in SPACs back then, and even today, and everyone should understand this, because a SPAC IPO is a financial investment, not looking at an operating company, it has been dominated historically and still is dominated today by what's known as the SPAC mafia, which is basically hedge funds, short-term convertible arbitrage desks, who are the biggest investors in SPACs. Now that's changing because increasingly we're beginning to see fundamental long-term investors in SPACs participate in IPOs. But even today, if you look at the largest investors, the top 10 largest investors are all hedge funds, who actually are very smart in playing this arbitrage game where there is no downside risk, or I agree with Gil, limited downside risk, because there could be fraud. So very limited downside risk with potential upside risk. And I think what happened in particular was people didn't think that you could actually make that much money in SPACs, because the increase in prices post de-SPACing was never that great, the increase. There was never any big pop the way that you get in IPOs historically. And that changed last year, actually, in April of 2020, when one SPAC, which was two companies that combined, a company called SB Tech combined with a company called DraftKings. The SPAC was Diamond Eagle Acquisition Corp. And they had gone public in May. They announced the deal, putting those two companies together in May of 2019, in December of 2019. And when it announced, as with many other SPACs, there was a slight increase in the price. And then they went on a roadshow and started telling the story. And then COVID came, and people thought that with gambling, with COVID, that there'd be a lot more people in it. But they did a very good job, and they built a book of using investment banks to basically get fundamental long-term investors interested in DraftKings, which is an online gaming company, and SB Tech is a tech company. And so even though the company was losing money and had, several $100 million in revenues, they had a valuation of $3 billion. And so when the deal closed in April, the stock doubled to $20. And that was the first time ever that a SPAC price had doubled in less than a year. So the investors in the IPO received the value of their warrants, plus, which trades separately from the shares, received a 2.5, almost 3x return in less than a year. And people were like, hold on a second, there is an investment category where I can have no risk and I can get almost 3 times my money in less than a year. This is exactly what I should be involved in. And I actually have a lot of friends of mine and individuals who hated SPACs or knew nothing about SPACs who decided after DraftKings that, you know what, I'm going to start learning more about SPACs and getting more involved in SPACs. And a lot of fundamental investors also made that decision as well. And if you look at the growth in IPOs last year, it didn't happen in January, it didn't happen in February, it didn't happen in March, it didn't even happen in April. It started in May after DraftKings. And that separation that we spoke about between the right to redeem and the right to get your shares back was not always the case. That rule changed in 2015. Actually 2014. And when that rule changed, that also led to a significant increase in the participation by certain people. Goldman Sachs, for example, wouldn't touch a SPAC with a 10-foot pole really before that rule changed. And after that, they now are one of the largest issuers of SPACs and have actually become one of the first bulge bracket banks to actually sponsor, not one, but 2 SPACs. And last thing on this is one of our partners strategically is Jeff Sprecher from the New York Stock Exchange. So we've spent a lot of time thinking about how to make SPACs better. And the New York Stock Exchange refused to list SPACs on the exchange. So SPACs were, until literally 2017, May of 2017, just 4 years ago, exclusively the domain of NASDAQ or other exchanges, not the New York Stock Exchange. And Sprecher and the New York Stock Exchange took the decision finally that they were going to allow one SPAC. And the reason they did it was because they had seen that a large number of well-known brand name institutional private equity firms and other firms were getting into the SPAC arena. And so they finally decided to do it. And when they did it in May, since then, they've now become firm converts and have listed several hundred since then. So I think the rules have changed, the product has changed, it's become more investor friendly, it's attracted more individuals in it, and I think the returns have proven to be higher. And I think the first one which started that was DraftKings, which obviously when people see higher returns, other people will follow.
Paul, you mentioned that you went from being an investor to a sponsor. Can you talk a little bit about what you found to be different in the way that you did sort of looked at a SPAC from that changing? And then Matt, you want to talk, would like to bring you in on this discussion. Talk a little bit as an investor, what do you look for, you know, when you're thinking about an investment and either an IPO or a SPAC? So Paul?
Yeah, for us, I mean, I think the key thing, you know, we were never a SPAC investor. You know, we're really, as I was describing earlier, you know, as our business is primarily owning and managing and developing, you know, real estate on a global basis, and as part of embracing technology, we really have had a tremendous insight and connectivity with, you know, the VC market and all these startup companies as they're pitching us to utilize their platforms in our portfolio. So after becoming a customer of a lot of these companies and then seeing the explosive growth that they had, we ultimately made a decision to be an investor in early stage prop tech startup companies, Series A, Series B investors. So clearly on the private side, investing along some of the smartest and brightest VCs in the country, you know, in these early stage startups. And we have now had, you know, we've been doing that since 2017. And as we're looking at these early stage companies, you know, clearly the goal for us is literally looking at utilizing our portfolio and figuring out who are going to be the winners and the losers from a technology standpoint, and being able to use our portfolio as an incubator and test case for these companies and making these initial early stage investments. And as we've watched and helped these companies grow, then we realized as we started seeing a lot of the customers we have, as well as some of the early stage companies we've invested in, as they grew and became public market ready, they started to actually go public instead of traditional IPOs. They've started going public with, you know, vis-a-vis a SPAC. So that was really, for us, the moment, just like we had the aha moment in 2017 where we said, let's stop just being a customer and creating a lot of value with our brand. Let's start being an investor in these early stage startups. We had the aha moment in 2020 in the middle of the pandemic and saying, well, great, we've been a customer, we've been an early stage investor, but now as we've helped them scale, they're public market ready, let's be a SPAC sponsor, because just like we help these early stage companies grow and scale their business with our brand, unlike a lot of other SPAC sponsors that will go out and IPO, a blank check company, where then they are bringing capital to a potential company that wants to go public vis-a-vis a SPAC. We bring so much more to the table than just capital. When we're out and when we actually went to work on the transaction, our first SPAC, when we approached Latch was in a competitive process, looking and speaking to more than a half a dozen SPACs about potentially helping them go public vis-a-vis a SPAC. And then from a process standpoint, they went and had all the SPACs that they were speaking to, pitched them on valuation strategies, terms. But for us, it wasn't just about an economic negotiation where we would actually agree on a value to take them public and deliver cash through the cash in our trust, plus raising a PIPE. What we were able to bring to the table is we brought continued growth for Latch that we had seen as an early stage customer of theirs, and helping them expand their market share within the residential space, within not only within our portfolio, but using our brand, helping them expand and not only where their businesses in the US today, but potentially using our brand and our portfolio globally, whether it be in Europe and other markets around the world, to grow their business. And then also as part of the de-SPAC process, helping them continue to grow and potentially grow beyond just residential, but to grow into other markets, whether it be commercial or other markets. So that's one of the key things for us on why we made a decision to be a SPAC sponsor, because we thought we really could distinguish ourselves, as long as we stayed in the lane and said, we're going to focus on real estate related prop tech and be a sponsor of that, because, as we all talked about, there's currently 450 SPACs that are in the market right now that have 135 billion in trust that are looking for companies to merge with. But a lot of those sponsors and SPACs really are just bringing capital to the table. And we really felt that having the ability to bring a global platform to help these companies continue to accelerate their growth on the public side was a strategic advantage for us. And that's why we went forward and moved into the SPAC space as a sponsor.
Terrific, Matt. So how, given that there are so many companies out there, and I know you have a particular niche you're interested in, but how do you decide where to put your money?
Yeah, first of all, more options is better. If you step back and look at public markets, the evolution over the last 20 years, the number of public companies has shrunk. And part of the reason the number of public companies has shrunk is, on the one hand, the growth of private equity. On the other hand, how difficult the IPO process became for good companies and incentives to stay private. It's not just the capital, it's the great entrepreneurs and management teams and owners that didn't want the burdens of being a public company. And so adding SPACs as a tool and a toolkit to allow companies to monetize, grow, and really markets to allocate capital effectively, that in and of itself is a good thing, first of all, from my perspective. As an investor, you want more options, not less. Second, it's, how do you underwrite them? Yes, my fund and our firm, what we do differently is we only invest in real estate companies in both public and private markets. On the private side, we've done 48 deals over 25 years, 13% net IRR across 8 funds, pretty good track record. On the public side, we've done double the real estate benchmark, less than half the net exposure. And there's one thing that ties that sort of successful investment together. It's good management teams with a good alignment of interest and a good business plan that are going out to execute with your capital creatively. So within the SPAC market, there's a few things specifically to keep in mind. Number one is, why is the transaction occurring and where's the use of capital going? Is the cash going out? Is the cash staying in? Number two is, how is the dilution? One of the things with SPACs is that one of the motivations of more and more SPACs is the return on sponsor capital is very good. Typically, sponsors do well when deals do well, but sponsors are incentivized to bring these deals. And so the dilution that comes with paying the sponsors, the bigger the target that you have, the less that dilution really impacts you after the fact. And one of the reasons you're seeing massive pipes with small SPACs is you decrease the amount of dilution that goes to the sponsors. And then lastly, it comes back to any good investment, which is, do you believe in the business plan and the strategy? I'm looking here at, data, and it sounds like Gil and David have better data than I do, but at the announced de-SPACs so far, the average return since announcement is 2.4%. So what that tells you is there's winners and losers. Some of these returns are enormous. Some of them are negative. It's a big market. Not every sponsor is great. Some of them are just okay. And so, you need to pick through the details, right? Who is the sponsor? Do they have experience? So you think about someone like Paul at Tishman Speyer. I mean, like that AUM and resume and length and understanding of real estate and prop tech and what works and what doesn't. That's differentiating versus, I think there's 9 prop tech SPACs right now. So, all of those things come together. And then I think we'll get to it later, but real estate specifically as an asset class is interesting relative to SPACs. It's sort of different in and of itself. So that's a totally different consideration.
I'd just like to add a little bit to what David and Paul and Matt just said. I agree with everything they said. In terms of the evolution of SPACs and why they're more investor friendly, the sponsor is a middleman, just like a general partner of a venture capital or buyout firm. And there are potential conflicts of interest with the limited partners or the public market investors in a SPAC. And in both cases, investors are committing or giving cash to the middleman, and there's some illiquidity that's therefore created once you've, as an investor, you've got your money tied up. And that's one of the reasons there are deadlines. In the case of a SPAC, 2 years. In the case of a buyout fund or venture capital, private equity, typically a 5-year investment period, and then 10 or 12 years for the money to be returned. But this creates a conflict where you've got this deadline. If a deal hasn't been completed as the deadline approaches, the middleman has an incentive to do any deal, not just a really good deal. And this is where the point that David mentioned in 2014, where the SPAC structure changed, where the voting of approving a deal and getting your money back got separated, because this deals with that conflict of interest, that if the sponsor proposes a merger and you vote against it, if there's no deal, the warrants become worthless. But that creates an incentive to vote in favor of any deal. But being able to ask for your money back removes some of that sponsor's potentially bad incentives. The sponsor's got a problem if the deal gets approved, but there's no cash left with which to complete the deal. And so this ability to redeem is a big investor protection that helps align the interest of the public market investors and the sponsors.
Jump in on that. So we can move on. Some have said that this market is becoming a bit frothy, right? We're seeing celebrities touting SPACs, and while all of you are professionals, these I would assume are also being sold to retail investors as well. So what do what advice do you have for the investor that is not an expert in this particular arena to make sure that there isn't this bubble? And do you think there is a bubble in this particular market? You mentioned numbers that seem quite astounding to me, in registration and having gone public. Is there just too much money chasing too few deals? So what are your thoughts about where the market's headed?
Can I jump in for a minute, Gil? You mind? I'm going to do it. Okay. I do want to actually revisit the points that everyone had made, and the market has certainly gotten robust, and there's a lot of capital, which is appreciated. It's gaining market attention, and again, we talk about just a better market understanding, of what's happening here, which we refer to all day, every day as an IPO alternative. Really, I think, an IPO replacement product. If you accept the argument that the current norm, the traditional S1 process has become stale and antiquated, governed by rules and regulations written in 1933, 1934, whenever it is, where companies are not able to give forward-looking guidance, companies are not able to give projections, etc. By reverse merging with what is already a public company, the process doesn't become easier, it becomes better. It's a more transparent process. There's no obviation of the regulatory requirement to provide 3 years worth of audited financials, as well as risk disclosure into the public domain. The deal does not get approved, right? The deal does not consummate until the market has the ability to weigh in. But this is really, at least in my opinion, the holy grail of SPAC and what this is all about, which I wish there was just there were more attention was put on this, which is from the time you announce your transaction until the deal is actually consummated, you have this publicly traded proxy period where the market gets to trade the security with perfect visibility, perfect transparency, again, for a period of bid-ask 90 days to 180, whatever it might be, until the SEC approves the proxy, with a floor of $10. Because the stock is really not going to trade much lower than 10 if the price is not right, because there's an arbitrage, right? Someone will be there at 9.95. Hopefully you can appreciate this. But what's happening on that back end is publicly traded price discovery. The SPAC sponsor announces his transaction at a certain valuation. WeWork going public at a $7 billion valuation or whatever the number was. But today the stock is trading at 13, right? The market is accepting with perfect visibility, perfect transparency. They're actually saying the stock is worth more. But if you look at the SPACs that have announced, I'll give you another statistic here. There are 123 SPACs that have announced transactions. 88 of them, 88 of the 123 are trading within 5% of cash and trust. 36 of those deals are trading below cash and trust. What that means is that the market is telling you that with all the information, they actually think the price is wrong. They do not think that the value of the transaction is fair. And what you probably are going to see happen, just like right in the traditional IPO process where capital markets takes indicative indications of interest and then decides where to price the deal, the high end of the range, the low end of the range, etc. The same thing should happen here in the SPAC space as well, where some of these 88 companies that are trading below cash, the sponsor is going to be forced to go back to the target and say, the deal's going to close because everyone's going to vote yes, right? Because they're perversely incentivized to do that. There's no reason not to extend the life of the warrant. But at the same time, there's going to be no money there, right? And you might get delisted because you may not have any shareholders. And therefore, we probably should lower the price of this transaction. And that's an uncomfortable conversation where the target company probably looks back at the sponsor and says, your promote is very large. And if I'm going to take some pain, you're going to take some pain. But again, what I'm trying to just focus in on is we talk about bubbles, we talk about too much capital, we talk about where the product's going. There is an advancement in the capital markets and the public markets, which are these publicly traded pricing periods. And I think that's very powerful. And I think the market has to really focus in on that element to see the real value of the SPAC product. Hopefully that makes sense. Hopefully.
So one reason we have bubbles is that price transparency gets distorted, right? So you have, David brought up DraftKings, right? So this is a sort of a household name, I suppose you would call it. You get investors who are really into, something that they know. And so do you ever see instances where the sort of as if pricing seems to be, like after the SPAC closes, the price then declines quite a bit because there was some over optimism before.
I'm going to talk for 1 second and then turn it over to everybody else. But you are correct. The statistics in February were the exact opposite. I would have been here saying something like there are 95 SPACs that have announced transactions, and 91% of them, 87 of the 96 SPACs that have announced transactions are trading above $11, $12, $13 per share. There was this probably erroneous, euphoric sort of response to SPACs that when they announced that we were that we had priced the deal at $2 billion and Fidelity did a $500 million pipe, or Neuberger Berman had done a pipe, that the market just made the assumption that the asset was worth more than $2 billion, and it traded it to 3, 4, 5, and all the SPAC sponsors got back online to do a second and third SPAC. But the market now, there have been some trades in the market, some data points that have illuminated this, where the market now says, wait a second, if Fidelity did a pipe at $2 billion, maybe it's worth $2 billion. Maybe it's actually worth less than $2 billion. And now the market is taking more of a wait and see attitude, or they're saying, show me the information, show me the proxy, let's do the roadshow. Let's learn let's get a better appreciation for what's happening here. This is all very rational. This is how markets mature. This is the right way investors are supposed to respond to these announcements. And if at the end of 3, 4 months, you decide to stay long the asset post-SPAC, when it just becomes DraftKings, publicly traded company that happened to have gone public via this methodology, whatever happens, happens. Some stocks will perform well, some stocks will not perform well. But SPAC is just the process by when it went public. I'll stop talking. I apologize.
Just 2 quick things on this issue. And I think we need to separate them. One issue are there elements of over exuberance in the SPAC market today? My answer to that is unquestionably. Do I think this is a problem for the SPAC market as a product? Do I think that the future of the SPAC market is doomed or harmed by this? Absolutely not. So on the first part of that, I think Jay has some data, which it'd be good if you can share it, which shows that the last time we've had as many companies that went public with zero revenue, no revenue at all, was the last time we saw it. The closest time before 2020 was 2000, which was the dot-com bubble. So a whole bunch of companies went public, and a lot of those, that ended up actually pretty badly. And I think in 2020, we've actually surpassed that number. No, the technology is very different today. Companies are doing many different things. Some of the markets that we're talking about are highly disruptive, like the space industry, which has a very high total addressable market, should be $1 trillion industry. Electric vehicles will in fact be very prominent. But I think it was the Wall Street Journal today that pointed out, or recently, that the first company to get to 10 billion in revenues as a US startup in the fastest time was Google in 8 years. And if you look at the forward projections, which SPACs are allowed to do, in fact, they're obliged to provide forward projections. There are several companies, particularly in the electric vehicle industry, which says that they're going to get to 10 billion in revenues in 6 years. And there are at least, I think, 6 or 7 of those. So if you believe that 6 or 7 of these companies are going to beat the Google record, it might happen. We don't know, but it's pretty unlikely, right? So there are some pre-revenue companies which are trading at values today, which are eye-popping, multi-billions of dollars, which is reminiscent of the dot-com boom. And I think it's fair to say that several of those companies are not going to do well. And you know what? Several of those companies didn't do well after 2000, and several did, and it didn't stop the tech sector, and the tech sector marched on. It's a great thing about markets. So are there a lot of SPACs out there? Are our prices higher? And do we have a lot of pre-revenue companies? Absolutely. But what we do have, on the other hand, is an industry, which I think Gil is quite correct in this, and I think the reasons that Matt mentioned and that Paul echoed for why he got into the market make a lot of sense. SPACs are a very thoughtful product that provides a very valuable service. It's just a mechanism for companies to effectively go public. And there are many companies which, as Gil pointed out, have a tough time going public in the traditional route because of the cost, the complexity, some of the regulatory barriers. So this provides a quicker, faster, cheaper, more flexible way, which has a dilution cost, no question about it. But it's clear the markets have said that that dilution cost is outweighed by the benefits. And the analogy that I use is that in the 1980s, a lot of people thought that this LBO industry was going to end badly. There was a bubble. It was about the same size as the SPAC market today, about $200 billion. And that didn't happen. They made a bunch of changes. It changed their name, one of the greatest marketing and branding exercises ever, from LBOs to private equity. And today, it's no longer a $200 billion industry, it's a $4 trillion industry. Similarly, the junk bond industry, whose founder actually went to jail, and many people thought, you're over-leveraging companies, this is a problem, this is an issue. That market was about half the SPAC market today, $100 billion in the late 80s, early 90s. And today it's a $2 trillion industry, again, remarked as high yield debt. And of course, the high yield debt is pretty much the same as junk bonds, with a few changes that have made it better. Similarly in private equity. And I really believe that long term, the SPAC industry is going to be a $1 trillion, multi-trillion dollar industry in the same ways that these others have, because it fundamentally serves a valuable purpose. And importantly, unlike those industries, which put a lot of debt on company balance sheets, for the most part, private equity SPACs are about putting equity on balance sheets and funding growth and facilitating growth. And I think that's a huge difference, which is very positive.
Oh, Kathleen, you're on mute. But look, can I just throw one thing in very quick on that? The only thing I'll say is I think bubbles make for great headlines because this industry has grown so fast. What you're pointing out from a valuation perspective, that's a broad market phenomenon. I mean, like I look at the Goldman Sachs has a bunch of custom indices. One is non-profitable tech. That's a $236 trillion index, okay? And those companies trade at 8 times sales. That index is at 8 times sales. And that index isn't a ton of SPAC companies. By the way, that index is only down 2% on the year. It's not like it's performing very poorly. At one point this year, it was up 25% in the middle of February. So like, there's lots of companies that don't have any profits across the whole capital markets. And there actually aren't, David hit on, space exploration. I'd say like SPACs maybe have been pioneers there a little bit, but for the most part, companies that have come public via SPACs aren't pioneers. You actually want to do the opposite, right? Like what you want to do is find a sector that the public markets value at a big premium and pay par or a little more than par for that same asset, because that's the arbitrage, right? Like you're a private company, you're not going to sell yourself or part of yourself for some discount. But what you might do is sell yourself at a fair price to go be valued at 20, 30, 50% more. So I think like the bubble headline is just because the numbers that like Gil threw out are just so big and they sound amazing. Broadly, within the markets and what should individual investors be aware of, it's, if you're going to invest in a space exploration company that's going to take people like Virgin Galactic into space, it's probably as risky as it sounds. And if you're going to invest in a prop tech company, or prop tech's one that we're involved in, but there's somewhat vanilla SPACs that come out all the time that have much more balanced risk rewards. And so it's just like every other investment someone might make.
So Jay, do you want to add before I'm going to turn to Matt and Paul and talk a little bit more about the real estate prop tech, what that is and why that might be well suited? Do you want to give us a little more, do you have any color you want to add to this discussion about pricing and.
I'm in general agreement with everything that's been said. One thing that I do want to add, though, is, overall, we're a bunch of cheerleaders for SPACs. But the sponsor promote does impose costs on the operating company. The dilution that's been referred to. A typical SPAC involves the IPO selling 80% of the shares to the public, and the sponsor gets the other 20% essentially for free. The sponsor then buys warrants. A typical deal, maybe a $200 million IPO. The sponsor puts in $7 million of cash, which goes to pay the upfront investment banking fees, so that the public market investors can start out with $10 put into the trust account, and a couple of $1 million is set aside for paying for directors and officers insurance and operating expenses of going public. But they're giving themselves $50 million worth of stock. So they're putting in $7 million in cash. And this is a risky investment. They might lose everything. But in return for $50 million face value of stock plus warrants, this is a pretty good deal, which is why sponsors have been coming out of the woodwork. And increasingly, as Paul was pointing out, operating companies are paying attention to not just cash, but the quality of the sponsor. Is the sponsor adding value to the deal in return for the equity stake that the middleman is taking? So just as doing an IPO is not costless, merging with a SPAC is not costless either.
I just would comment that the promote is an ask and not an entitlement, and there's no reason that the company has to agree to merge with that SPAC and that sponsor if they don't think there is a value proposition affiliated with that partner, right? As Paul has explained and David has explained, they bring years of experience working with companies, helping companies grow and achieve sort of like goals that they may not have been able to do, without that sponsor. So
yeah, and as was pointed out, if the deal is in trouble, if there are a lot of redemptions, or right, if a pipe investor gets concerned about valuation, the sponsor frequently takes a haircut, giving some of those shares to a pipe investor or forfeiting them in order to reduce the middleman's cut.
Right. I think I am always optimistic that investors recognize when they buy SPACs at $10 that they have appropriately incentivized their sponsor to go back and bring a great deal to the market at an attractive valuation. If they do, they're incentivized properly. If they do not, chances are that they will not end up earning as much of the promote as they thought they would.
Great. So Matt and Paul, I wanted to go ahead. You can talk about this, but I wanted to, because we are, coming on. We have lots of questions in the chat. We got many of them regulatory done, but I wanted to talk a little bit more about the real estate market and, prop tech in particular, what you talked about. There's been a question in the chat about WeWork, what that, they tried to go public and then had to pull back. So wanted to get your thoughts more on whether SPACs are a better vehicle or a more efficient vehicle for some of the real estate transactions that are occurring in a particular space.
From a transactional standpoint, again, I think when I look at the SPAC market, I don't think that it is a distinguishing factor as far as a company being better, poised to go public, as far as a real estate perspective. I think real estate is no different when you think about real estate prop tech, than all the other companies that are going public vis-a-vis a SPAC. I think the reason why real estate prop tech companies are going public vis-a-vis SPAC is for the same reasons we've talked about. It's an easier process. There's more certainty in the process. It's a quicker process. And, I think what we've seen now, at least and why we've really focused on the real estate prop tech space, I think just like a lot of other companies, there's been a tremendous explosion over the past years of private equity, VC capital raised, and companies have stayed private much, much longer. So now there are a lot of companies that happen to be public ready, and we've started to see that. And that's one of the other reasons why I just throw out there that where we've really seen a real explosion in SPACs, because it's not just that it's picking up where the IPO market left off because it's a lot more efficient and flexible, but there's also a lot more public ready companies now because companies have stayed private a lot longer. But as far as from a real estate company perspective, when I look at and think about real estate prop tech, real estate was probably the last industry to embrace technology. So we are really in the early innings of really disrupting the real estate business through the use of technology. That's what really excites us about real estate prop tech and why we focus on that from a business standpoint. I'd say we're in the second or third inning. When you think about, office buildings, residential buildings, the way that, technology has been implemented into these buildings, we're scratching the surface, and there are a lot of great new companies that are coming to the market. And I think, the WeWork question on, they tried to go public, they failed. That wasn't a SPAC versus, IPO issue. That was really just an ultimate fundamental valuation issue, as well as a business focus issue. Their business was previously, when they tried to go public at a much higher valuation, was a much broader and diversified business than what they have today. And I think they've really gone back after their failed attempt, from an IPO standpoint, and they've really shrunk and streamlined and focused their business in a much different way. So it's not really a question of SPAC being successful, IPO being unsuccessful. I think it was really a fundamental change in their business. So, I mean, that's specifically on the WeWork side.
Yeah, let me, in that same sort of question. So one part of it, I think, is, we've looked at SPACs for traditional real estate multiple times over multiple years, and there's been a few, but real estate, commercial real estate is like an $11 trillion asset class in the United States, of which only 10% is public in the public REIT market. There's a huge amount. So 90% of the market's in private hands. Most of that over time, you'll see more transition to public markets in some way. Real estate is quite bad in a SPAC structure for a few reasons. So like number one, it's very asset heavy. And because the private market is 10 times the size of the public market, pricing is very transparent. So you're not going to buy a piece of real estate and have it trade at double the value when you announce a SPAC, which means that it's hard to absorb the warrant and promotes that come along with the SPAC. So that initial sort of 20% that the sponsor gets in the shares, and then whatever the warrants do along the way, there's not enough of an arbitrage, even in the highest valued sectors in commercial real estate, to make that math work. And lastly, real estate's a low growth sort of sector. Now, prop tech is entirely different. That's why you haven't seen a lot of real estate SPACs. It's why even today, there's a number of people exploring sort of distressed real estate SPACs where you raise $200 million and you buy a bunch of empty hotels. Even that strategy is somewhat questionable if it'll actually work. We had one SPAC announced to buy a data center business, which is one of the highest valued subsectors of real estate in the public markets. And that one, I don't know where it is today, but recently was below 10, as Gil was alluding to this potential change of price dynamic. So real estate itself has not been a great asset class. Prop tech should be fantastic because prop tech is a nascent industry. It's very high growth, and it solves an underlying business problem or a set of problems that exist in an industry that's been slow to accept it. So, there's a big dichotomy. I highly, highly doubt you see many real estate SPACs. And I would expect, particularly, the success that you've seen with Latch, the success of, I think there's eight to 10 de-SPACs in prop tech. They've all done well. On WeWork, I'll just throw in the SPAC. I can make an argument that the SPAC was a better execution for WeWork's issues than an IPO would have been. Because if you look at the market today is valuing WeWork at $11 billion. When they wanted to go public, it was 40. That was like absurd from a real estate investor standpoint. 10, I think, is where like they got recapitalized from SoftBank. What the SPAC did for them is, number one, bring fresh cash onto the balance sheet in scale. That would have been hard to execute through an IPO. So SoftBank and other partners are going to continue to own somewhere around 82% of the entity. If I started in investment banking, structuring an IPO where you'd have such a large shareholder role and trying to price that minority interest that you're selling appropriately would have been really tough. Secondarily, like I said, where SPACs don't tend to be pioneers, WeWork's multiple in the public markets is partially driven by another public company, IWG, that owns Regis. So why has WeWork traded up to $12.45 from $10? Part of that is because in the out years, it's still at a discount to its closest public comp. So again, WeWork sort of highlights some good dynamics. All the headlines are like, oh my gosh, WeWork's this terrible business and blah, blah. That might have been true in 2019. If you look from here, you have a company that's discounted relative to its peers with better growth, and the PIPE investors were legitimate, and the market is telling you that this was a good deal. So it's sort of a good case study on why SPACs can work better than IPOs in certain instances.
There have been a number of questions in the chat on regulatory issues. So the SEC is taking, as they usually do, when markets are popular. And of course, they're seeing a lot of this because it's a fairly transparent market for the SEC. Unlike things like cryptocurrency, which they don't oversee, these SPACs have to go through registration at the SEC. And so therefore, they're taking a deeper look and can see a more holistic view of the market. But they have been talking about new accounting rules, for example, and new scrutiny. What do you think this will do? So we had two questions actually on the new accounting rules that might put warrants on the balance sheet as a liability. And then another question that talked about SPACs not being eligible for Rule 405. In other words, they might not be able to have as much access to the market. So do some of those restrictions cause them not to be able to go to the market as frequently, and why isn't that discounted? So let's start with the regulatory issues and tell me what you think about. These are not clearly not the blank check companies of old where there were so many rules on them. So anyone, you can jump in as you like.
Yeah, I'd like to take a stab at the warrant expensing issue. Warrants are the most common form of warrants are employee stock options. For decades, there was an issue about corporations expensing employee stock options or not, where finally, starting in 2005, companies were required to count employee stock options as a compensation expense. The world did not collapse. The accounting became more transparent. And there had been a lot of people saying that the world would collapse if growth companies had to start expensing employee stock options. So, there are cases to be made for and against counting sponsor warrants as a liability and expense on income statements. But I don't think it's going to have a big impact on the merits of SPACs versus traditional operating company IPOs.
Yeah, I would agree. I think it's just it's really just going to create a delay and a backlog in the market as people now try and implement these new rules. And I think even in addition to the warrants, being taken as a liability in the balance sheet, what we're seeing already, just given all the press and the focus, on SPACs, is the SEC is really taking a much harder look, at disclosure requirements. So I don't think there's going to be a fundamental shift, in the valuations of SPACs or the number of people utilizing SPACs. I think it's going to be just a delay in the process and an enhancement of disclosures as opposed to any significant fundamental shifts in the structure of a SPAC.
And the ad would be that it's welcome. At this point, SEC regulatory scrutiny is a good thing. Let the market get comfortable with what's happening. Let them offer an opinion, etc. And all of the bankers, the sponsors, the target companies, everyone will comply. And I think that's a good thing.
Yeah, no, it's consistent like we were talking about before, in addressing the bubble issue. I think I echo what everybody said. And the bottom line is the market on the SPAC side is an efficient market, and we've seen that. We've seen that with the pricing of the existing shares, and as well as companies. It's the big change where we saw, and there was we talked about, and I think Gil, you mentioned this earlier about you would have suggested that there was a bubble based on pricing at the end of February, but what we really saw happen is efficiency in the market. It wasn't just the SPAC market; it was the overall stock market where there was a real push on growth, on growth companies. And that push, and it wasn't just in the SPAC market, which is really what's dominating SPAC, where we've talked about a lot of companies that are really focused on asset-light business models that have high growth. But growth was a theme across the existing stock markets that was really getting bid up. And the markets had a rotation out of growth, which included, a lot of the SPAC vehicles, in March and April. So that's, I think very efficient markets we're seeing right now.
I should add just one very quick thing, that on this particular issue related to warrants, if you actually look at the guidance that was provided by the SEC, they did not say in the way that there was a formal change that stock options need to be expensed, so they need to be treated differently. The SEC didn't say that warrants in SPAC should be treated as equity. What they said is that the way that certain warrants have been drafted in the past by certain SPACs, and we reviewed certain SPACs, have a very technical element in them that could be construed as not necessarily equity, and therefore the SPACs should be very careful in reviewing them to determine whether it should be treated as liabilities or not. In my mind, reading between the lines and looking at the statements that the SEC has made, the SEC just basically said, something, there are way too many SPACs coming to market. We need to do something to slow it down. And what this does, because the most important element of this announcement, the guideline provided by the chief accountant of the SEC, is every single SPAC, we are no longer going to make any registration statement effective unless you confirm to us that what the nature is of your warrants, that they are done in a way that it's not material, which, by the way, most of them are going to find that it's not material. It's almost impossible to figure out a way that the warrants, which are a small part of the capital structure, will be material. But you will have to get every accounting firm to say something about it. And what it's done is now created a stop, effectively, on every single statement, because the SEC is not going to approve anymore of the 250 plus that are on file unless the accountants do this. And there are two accounting firms in America which control something like 80% of SPAC accounting or auditing, which are Withum and Markham. So by the way, those guys are going to have a lot of sleepless nights doing a lot of work. Thankfully, we had shifted our accounting firm, so we don't have the same issue. But what they're doing here is, as Paul said, requiring greater disclosures and requiring greater clarity, which I think Gil is absolutely right, is a positive thing. But this salvo is really just too many SPACs. We need to find a mechanism to slow them down. And I think it's only going to be good for the market, because there are, of that 260, some of those should not be in the SPAC market. And hopefully many of them will withdraw or decide that they're not going to move forward. And I think that's only going to be good for the SPAC market, because you'll have effectively by default a flight to quality.
I would agree with that. As I said, I think that the SEC is clearly slowing down the SPAC process, which will slow down the market and creating efficiency. But even before the SEC, as we talked about, I think the market is very efficient. As we came out of that bubble period, just as a general matter, where values for growth were up, you just put it in a quick perspective. for the period ending, the week ending March, I think it was March 21st, there was almost 35 billion of new IPOs for SPACs that week. For the period ending a month later, it was April, it was 1.4 billion. I mean, just think about the shift in a month, from 35 billion to 1.4 billion. And so it's an efficient market, and that's one of the things, when I look at it, that's really the market's maturing, it's evolving, and I believe it's here for a long term. Will continue to grow, just given the efficiency of it.
So do you think it's the staff that's overwhelmed? In other words, that I assume this goes through Corp Fin, right? So how many SPAC Corp Fin people do they have? And so, maybe perhaps they're being overwhelmed and they need some way to, I don't think they want to slow it down from an investor viewpoint, but perhaps they're having some issues. Qualified individuals to review the documents. As I'm assuming,
I think they want to slow it down.
Yeah,
Okay.
But the market was slowing it down even without the SEC getting involved.
With an IPO, in an S1, the staff has to review everything. So the staff has to obviously review the formation of the SPAC. But what about the merger? Do they have to review every? They do. Okay, so the staff has to be involved in all of it.
Entity. Every single SPAC, wherever they are in the process, is going to have to, at the very minimum, get their accounting firm to give a view on this issue. For some of them, it's going to have to be a valuation, and for some of them, it may have to be a restatement. I highly doubt there'll be a restatement, but what it does is require every single SPAC to actually make changes. And what's going to happen, by the way, going forward is, we already spoke to the lawyers. They know the change to make to the language, right? So it's not that we're going to go forward and classify warrants. Yeah. They're just going to change the language in the warrant agreement to make sure that it's clear that it is, in fact, equity. And they're doing that right now. I mean, there's a whole little cabal of lawyers who are meeting as we speak. We're finding the right language, and they're all going to use that language going forward. And it's going to be the exact same way as it is today in terms of treatment. It is not a change to treat warrants as debt. It is a way to slow things down and encourage people to be more crisp and clear in their disclosures, which makes a lot of sense. Can I say one very quick thing about the market? Because I agree with Paul. The market is efficient, but it's also creative. And SPACs are a great product for facilitating creativity. There have been a number of people in the SPAC market who have taken SPACs and done some fascinating things. For example, Group 9 Media has found a way effectively to announce, and we'll see if it works and the FCC approves it, where they said, one of the rules in SPACs is that you can't know the company you're going to buy ahead of time. That's very important to understand. Or you can know them, but you can't have an agreement in place.
I think we've lost him. Have we?
Yes.
Just me?
No, he froze.
You froze there.
Oh,
the
sorry.
last thing you said was you can't have an agreement in place.
You can't have an agreement in place. So what Group 9 Media has done is they've said, we don't know the company we're going to buy. When we do buy that company, when we're a regular way public company and we no longer have any restrictions, we're going to merge ourselves into that company. So they basically said, we're going to become a public company. But on the real estate side, there has been, I totally agree with Matt, that real estate's a tough asset for a SPAC to do. But there is a precedent. Back in 2007, there's a SPAC called NSDC, which raised $400 million. And in August of 2009, they converted into a REIT. They actually bought a REIT. And the name of the REIT is actually pretty cool. It has a great ticker. You can look it up. It's ROIC, which for business school people knows means return on invested capital. But the REIT name is Retail Opportunity Investment Corp. And they focus exclusively on shopping centers. And they've obviously been challenged in COVID, but it's still a multi-billion-dollar company. And it is the only example I know of. But in my mind, there's no reason why there can't be others where you effectively, a SPAC acquires a REIT, which has happened and I think could happen in the future. It depends. And particularly in this market is the type of thing which I think a creative SPAC fund, especially with the numbers that are out there, might think about and probably should think about.
So I want to spend the last few minutes on international competition. So I understand that there have been in many countries some restrictions on the SPAC structure, for example, the dual class nature of the shares. I know, Jay, you're going to be talking to a group of investment bankers, right, in Asia. What are your thoughts about, other countries look to the U.S. capital markets as sort of a bellwether for things that are going to be popular? Do you think that SPACs are going to start seeing some competition from other countries to try to do their own SPACs? I mean, Grab is a good example, right?
Yes, it's kind of an embarrassment in Singapore that Grab is going to become listed in the U.S. Now, part of this might be that U.S. capital markets are very deep, and Coupang, the Korean tech company, just went public in the U.S. Partly because of a perception that U.S. Equity market investors are willing to pay up for growth. They understand the business, and capital markets are deep. But indeed, a lot of countries are revising their regulations to avoid a one-size-fits-all regulation that might have prevented SPAC IPOs from occurring there. For instance, the dual-class stock aspect, as I pointed out at the beginning, with the insiders, the sponsors, they've actually got inferior voting rights to the public market investors, kind of turning on its head the usual dual-class structure.
Anyone else want to jump in on the international issue?
Just one.
Listen, I think, go ahead.
Very quickly on this, we're currently doing a SPAC focused on Southeast Asia, like we're Ultima. And before Grab, by the way, there was another company called SCA in Southeast Asia, which listed on the New York Stock Exchange in a regular way IPO at a $4 billion market cap, and today it's over 100 billion. It's actually done even better than Tesla, if you can believe it. So it is a very exciting area, and it is the fastest growing internet economy in the world. I do think we saw that an Indian company, Renew Power, announced the deal, the first major Indian company to be listed through a SPAC on an exchange. And I actually think it's going to happen more frequently. And I think that's a good thing. One aspect about SPACs, which I think is a real positive, is that it provides for companies that typically may not think that going public is available to them to go public. And that applies to companies, very good companies and large companies in places like Africa and in South America. One of the best performing SPACs, obviously DraftKings is probably the best performing, and they doubled to 20, and today I think they're over $60. But there's a Mexican company called Betterware, which is, up for, I think, 3 or 4 times since they went public last year. So there are opportunities for bringing companies that wouldn't otherwise think about US markets that SPACs can facilitate. And I think we're going to see more international SPACs going forward.
That's great. So we have just a couple minutes left, and I thought I would give each of you just a moment to sort of make a point, any points that you feel like you didn't have an opportunity to do. And if you don't have a point, to let our attendees know what you think the future of this is. I mean, it's is this going to be just sort of the regular way? Do you think that most companies will choose to do a SPAC rather than go public? We do see some direct listings, a few of those. Do you think that this is the future and that we'll now again see a robust IPO market? So David, do you want to finish us off, and then we'll go to Gil, Matt, and Paul.
Sure. One thing I would like to point out is that the hype associated with SPACs is because the number has increased in a fairly short period of time. But the reality is that the 500 plus SPACs that are out there today, which represent 170 plus billion in cash and trust is what it's called, are responding to a supply. And that supply has come, as I think Matt pointed out earlier, from the tremendous growth in private equity and the tremendous growth in venture capital. So compared to the decline in public companies. So there used to be 8,000 plus public companies in the United States 25 years ago. Today, there's 4,000 and growing. So almost a 50% decline. But the amount of money going into public companies has probably quadrupled or quintupled over that time period, over the past 25 years. And at the same time, The number of private equity companies has grown from around 2,000 to well over 8,000 today. And the number of venture capital firms has grown from around 2,500 to probably 13 or 14,000 today. And no one knew what a unicorn literally was 5 years ago, right? They thought it was an animal. Today, it's a very important company that can go public. And one of the biggest, in fact, the biggest SPAC deal ever happened yesterday, was announced yesterday, which was a unicorn out of Asia, $35 billion. So this SPAC market is a response and a solution to the high growth of many highly levered private equity portfolio companies and the rapid growth in many highly valued venture capital companies. And SPACs are simply a ventilation mechanism for that. And so I think this is, as Paul said, the market at work. The market is providing a solution which makes sense. And if it gets too frothy, then the market corrects, right? And if there's good opportunity, then the market goes up. And I think that's a very, very good thing.
Yeah.
If I can, I would start by saying I hope everyone enjoyed this panel as much as I did. Paul, Matt, David, and Jay really know their stuff. And I thought that this was extraordinarily insightful and accurate. I hope everyone walks away with a better appreciation for SPAC being a process more than it is a product, a methodology by which companies go public. It's something that enhances creativity on behalf of market participants, something that I think accrues to the benefit of the fundamental investor, of the individual investor, their ability to buy SPACs during the searching period and have the front row seat to what could be, again, a unicorn going public on a risk-adjusted basis, backed by a portfolio of short duration treasuries. Again, no one has ever voted, give me my money back, and not gotten their money back. And again, something I think it's a new technology that exists in the market that addresses a need. Again, more transparency during the IPO process. So thank you very much for having me.
Thank you. Jay?
I share Gil's thoughts. I think there's widespread agreement that the last couple of months that there has been a bubble in terms of the volume of deals. But there have been other markets, including the traditional IPO market, that have had bubbles at times. But as all of us have emphasized, the market learns. And we're moving to a situation with a more sustainable number of deals, more sustainable deal structure, where deal terms are evolving and structure is evolving to reduce conflicts of interest, to align incentives. And I think SPACs are here to stay as part of the ecosystem for private companies to go public.
Pat?
Yeah, I'd echo all that. And, the only thing I could add in terms of what I do every day is, SPACs are, the modern SPAC market's pretty new, and prop tech is pretty new. And when you combine two new things, there tends to be a lot of opportunity. And so, relative to real estate investors that might be on the phone or on the webcast phone, to me, the most exciting thing within SPACs for what I look at is prop tech and the amount of companies that are out there that could be public and how they could potentially change the way that we interact and manage and earn profits from real estate. And that SPACs are an ideal way for those companies to come public because of the SPAC structure and the cash that comes to them, the price setting that happens, the PIPE investors' ability to validate price. So going forward, I think SPACs will be part of the market, but specific to real estate, I think they'll be a very important tool in the toolkit for prop tech to grow.
Great. Paul?
Listen, I echo with every one of my fellow panelists that have said, I think, listen, SPACs are here to stay. Clearly, like anything else I've always said in life, if you don't change, you die. And clearly the SPAC market has evolved and it's becoming more and more efficient and will continue to evolve. And I think it's going to grow and flourish. And I think and to Matt's last point, specifically on the real estate side, as I noted earlier, we're in the early innings, and not only as a SPAC sponsor, but as an owner and operator of real estate, I think there are so many great companies out there, and we're scratching the surface on how technology could disrupt the real estate business. And so I think that's going to come for a long time, which is great for the real estate business, great for our operating business, but also I think really just great for the SPAC market. And this has been a really great event, and I appreciate being asked to join this panel.
Well, you all were just absolutely terrific. I thought the discussion was lively and everybody participated so well. Again, this event was brought to you by Lehigh's Center for Financial Services and the Goodman Center for Real Estate. If you're interested in our centers and our events, please look us up. And I want to say thank you so much to all of our distinguished panelists, David, Gil, Jay, Matt, and Paul, for spending time with us and sharing their insights and expertise with us. I know you're busy, and we much appreciate your participation. I also want to thank McKay Price for suggesting this event. I think it's timely and definitely something that we all learned a lot. And of course, this could not be done in such a nice way without the help of Shannon Smith and Meg Wolf. They planned and produced this event and did a fantastic job. So I hope all of you who attended will join us again in the future, and otherwise have a good night.